good afternoon, everyone. So I'm Will Matthews. I look after our commercial research at Knight Frank in the UK and also in parts of Europe and globally as well. I've been with Knight Frank a couple of years now. Before I joined, what they didn't tell me was that I actually share the same name as our head of our country estates department, which means the first week I was there, I was inundated with these amazing houses, villas, even islands to try and sell for people. Needless to say, I wasn't very good at that, didn't sell any of them. And then they realised what was going on. But that is actually often the perception of Knight Frank, that we do that kind of real estate, and we certainly do, but actually it's only about half of what we do. So the other half now is absolutely commercial real estate. We're very much a global practice, and that is increasingly what myself and my team is involved in the space.
Great. Boudewijn.
My name is Boudewijn Ruitenberg. I'm a CEO of Edge Technologies, well known as OVG in the past. We are developing offices mainly. We do some resi as well. We are currently active in 4 markets: the Netherlands, Germany, UK, and the US. What we actually make, the name Edge stands for a product, a working place environment, and is driven by technology, sustainability, and more focused on health. And so we're really a product-driven developer. And what we try to do is to enter new markets and bring edges to the new markets.
Good morning, everybody. My name is John Mulqueen. I'm head of offices for EMEA for CBRE Global Investors. We act for a very wide range of investors who look for assets right across Europe in offices, retail, logistics, nowadays residential, hotels. So we have a very broad church in terms of our client base. But I represent the offices part of the business today.
Great. Andrew.
Super. So Andrew Westbrook, I'm a partner with RSM. RSM is a large multinational accounting, tax and consulting business, and slightly different to the other chaps on the panel. We tend to come in and keep our clients healthy through their entire life cycle through to when they exit. The majority of our clients are either funds or investors or estates. And I have the privilege of looking after the real estate side, but also looking after a large number of our retail clients as well. So quite a lot of fun, really.
Great. Let's maybe just pick up with a snapshot of where we see ourselves at the moment in the market. John, I suppose, how are you seeing things in comparison to the same time last year? What's your sense of where we are in terms of the office sector in Europe?
Well, compared with last year, I guess last year there was a really high volume of transactional activity, which has slowed down a fair amount this year. I guess that at the beginning of the year, there was a feeling that there was a much more focus on being late cycle and about much more focus around the risks of being in real estate. I think that actually during the course of the year, we've seen the cost of capital has stayed lower for longer. And as a result of that, there's a very attractive arbitrage between investing in real estate and bonds, and therefore the capital is again refocusing on being deployed in real estate. And in that context, I think offices offers a really good opportunity because we have very supply-constrained markets still in Europe, and we also have the availability of assets. So when you're trying to deploy capital, offices is definitely one of the sectors where you can make a meaningful investment.
And Will, it's interesting. I mean, you're far too young, probably. But I remember there being a time when everybody was talking about home working because as soon as broadband came in, offices would be no longer needed. Everybody would work from home. But that doesn't seem to be happening. What's your sense since, you're obviously looking at the research and strategy side of it. What are you seeing in terms of the future at the moment of the office sector?
Well, I certainly agree with that sentiment. I think, yes, people like the flexibility of being able to work from home and work remotely, but actually people don't like to do that on a daily basis. They need to come together and work, and that is really what offices are very good at facilitating. I guess for us, just sort of standing back a little bit, I very much echo the sort of points that John was making earlier on around where we are in the position in the cycle. So we're definitely looking at the cycle in much the same way, saying we think it's going to extend. Yes, we look at the policymakers, they can understand that there's potentially a slowdown in the economy and they're ready to act through monetary policy, but equally increasingly through fiscal policy. So we think that's quite supportive. And I just think look at some of the research actually that I get across my desk from wealth managers, equity analysts, and they are advising their clients to get back into real estate purely for that sort of yield arbitrage. So on that basis, we think it's actually got a little bit further to run.
Okay, good. And Boudewijn, just in terms of what the Edge are doing, you're obviously designing and building the product almost for the next generation of people. So just tell us a little bit more about, I suppose, the aims of that and what that means in terms of the designs that you're creating for that market.
Of course, at the end of the day, we build buildings for users, for occupiers, but our product is bought by investors like John. So they need to be future-proof. And now I think what is really crucial is that buildings, do contain a lot of technology to be able to, to be prepared for the future, but they also should be prepared for flexibility. And that is a little bit of difficulty because bricks and mortar it's not flexible by definition. But at the same time, also the investors, the funding party, including banks, they want to have secure cash flows. And so there's a little bit of a gap between that. Users want to have flexibility, want to have a minimum service level, want to have a nice experience, and capital markets want to have stability. So what we try to create is a lively building where tenants get access to dedicated spaces, but also to a minimum of a sort of overflow spaces where they can use meeting rooms, they can have a sort of co-work environment experience, including food and beverage, so that they can really breathe into the buildings. And this is all driven by technology, because we believe that that it was strange that in an iPhone 5 years ago there was more tech in than in an average building. And so we believe that in order to run buildings efficiently, you have to apply technology. And the most simple reason for that is that a conventional building is always switched on. From early in the morning to late in the evening, it's either cooling, it's either heating. It's always consuming energy. And if you make use of sensors, you can easily adapt the building, because not every room is filled, so you can adapt the amount of air coming into the building. So and that really saves a lot of cost. And there's multiple other examples for using technique and save cost and be more flexible. But I can tell about that later probably.
Okay, good, and I'll definitely come back to that. Just Andrew, from your point of view, because you mentioned there that you're also representing the retail side in the sense of the occupier side here, or guests, depending on how we want to talk about that. What are you seeing as the drivers? And also just pick up a little bit for me in terms of the flexible space, because obviously that's been hugely dominant, particularly in London where you're working. How have you seen, I suppose, some of those trends influencing what the occupiers are doing and looking for?
So I think, just really to pick up on the flexible workspace, if you've got an occupier looking to take 60,000 square feet, what they might do now is take 50,000 square feet at a sort of representative rent, and then they'll look to a WeWork or an alternative provider to provide that surplus. And that's very different to 10 years ago, where somebody would have taken 70,000 square feet and given themselves capacity for growth. Business don't want to commit going forwards. In terms of what tenants are looking for, very much the food and beverage, but also looking sort of holistically at the employees who are actually going to occupy the space and saying, well, we need dentists, we need doctors, we need physios in and around the proximity of the building. So not just looking to fill commercial space with tenants, but also looking at the needs around that and how they can better be served. That's the trend we're seeing.
Okay, good. And Will, in terms of that, do you see flexible space becoming, I suppose, an ever-growing part of the market, or is it a trend, or how do you see that?
Yes, I think we definitely do see it's a growing part of the market. I think the concept of flexibility is something that tenants will always enjoy, and it's definitely something that developers should be mindful of when they're developing their assets. I think clearly in some cases there's a limit to how much flexible type space works best within an office, and that sort of depends asset by asset. But I think in reality we're sort of just working out where we think that limit is in the market at the moment, so possibly a little bit early to tell.
And do you think that there's a sense that, I mean, Andrew there was saying that they might have gone for a larger office size, and actually what they're doing is choosing this and then having flexible space. But is that reducing the overall amount of space that people are looking for, or is it actually acting to increase it because they add actually more in terms of flexibility? Is there any data around that?
Well, I think the way that we would look at that is what we'd say is that actually for that core space, corporates are prepared perhaps to pay a little bit more for that, recognising the fact that it's difficult to attract staff at the moment. We've got record low unemployment right across Europe. And therefore, it makes sense actually to pay a little bit more there, because actually the real estate cost in the grand scheme of things is not as large as it once was, and labour costs are increasingly only going one way. So we think that people will pay more attention to that core space, and then the flexible space, well, that makes perfect sense, particularly at this point in the cycle when everybody's looking for a bit of flexibility.
And John, I wanted to pick up with you just the point that we mentioned around technology, innovation, future-proofing, which is obviously very key for longer-term substantial investors like CBRE Global Investors. How do you, I suppose, how are you looking at that now? And also, if you want to pick up anything on the WeWork thing, because I think it's very interesting that what Will mentioned there around, is there an ideal thing for an investor, i.e., it would be great if you could have 50% flexible and 50% not, or so if you could just pick up those, that would be great.
Boudewijn and Will both picked up on topics around long-term sustainable incomes, and actually from our clients' perspective, that's the way that we do that is no longer trying to tie them into a long-term lease necessarily. It's more about our investment strategies to invest in the best places, but also about the way that we operate our buildings. So that is making sure that we make them technology enabled, make them ready for the future, that they meet the ESG requirements, but then the flexibility piece is also something which has really come up the agenda for occupiers. To answer your question directly about what's the right proportion, there's been quite a lot of debate about this. The investment market feels, it seems, the sentiment is that if you have less than 25% or less of a serviced or a flexible office operator in your building, then that can be accretive to the value, actually adds value. And the reason for that is because, to your point, occupiers will take the space they need all day, every day, the core requirement that Will talked about, but they'll be able to flex in and out for meeting rooms for, when they're busy, and they can take that additional space. And occupiers, therefore, will pay a higher rent for the core space because they know that flexibility is available when they need it. So there's a really kind of synergistic way to deliver something that we're all talking about here. I don't think there's any kind of clash. There is a good way to do it that suits everybody.
Because it's interesting. I mean, one of the things I think when you look at disruption and WeWork and flexible offices and those kinds of things, I remember a stat that when Uber came into New York, the traditional taxi drivers, a lot of them died away, but actually the number of taxi journeys went up by about 5 or 10 times. So there's a huge increase in the volume and the access to taxis.
Can I just jumping onto that, the point you made earlier about broadband being the innovation which meant people worked from home. Actually what you're finding is there are a lot more people, because of the WeWork phenomenon, coming out of their home and being able to work in the city. So the opposite has actually been true.
And just I wanted to pick up a little bit on capital flows, because obviously you're seeing less capital flows at the moment into areas like retail globally at the moment, more going into residential. What's the position at the moment, Will, in terms of those capital flows for the office sector especially? Are you seeing differences if you look at the different geographies?
Yeah, a little bit. So numerically, actually, there hasn't been definitely the sentiment is that activity has slowed this year, and clearly it has, but not dramatically when you look across Europe. But I think what has happened, though, is the sort of ranking of those recipients of capital has changed. So now we see Germany as definitely the number one recipient of capital for office investment, whereas a couple of years back that would have been the UK, and for obvious reasons that's shifted. But in essence, those sort of top 3 or 5 countries around Europe still are relatively similar in terms of that makeup. But the thing that we're probably seeing is that whereas a lot of that money would have been going into the key capitals of those countries over the past few years. Now it's increasingly broadening further out, so it's going into those second-tier cities a little bit more than it was a couple of years back.
Okay, good. Noticeably at MIPIM last year, although I probably shouldn't mention MIPIM at EXPO, but anyway, at MIPIM we interestingly were about 3 weeks away from Brexit at that point, and we are interestingly again possibly about 3 weeks away from Brexit. Interestingly, you've decided as a company to do your first development in London. What's the sense from people about particularly London and how that either will be influenced or not? What's the view, and I suppose what are you seeing from an occupier side? What are you seeing from an investor side, particularly looking at the London market? And that's to anybody really.
You want to take that one?
Yeah.
Maybe start with you. Maybe start with you and why London? Why now?
I think London, is the capital of the world in many ways. From a financial perspective, but also from a tech perspective, it's so dominant that it passed New York in many rankings, and so that Brexit thing is a one-time event. The question is when will it happen? But at the end of the day, it's too strong. It will go further, and so we believe in London on the long term, and we thought we could take advantage of a little bit of the momentum caused by Brexit, because I think it's for 10 years now that all the markets are overcooking, the occupier market, the tenant market. So there was a lot of pressure and limited chance to get access to that market. So we made use of the momentum. And we strongly believe that it will remain the capital of the world in many ways.
Okay, good. I'm going to come to you in a second because I want to put it in the context of the other European cities. But Andrew, you're focused on the UK.
Yeah.
What have you seen in terms of either reticence or positivity or?
I think if we look at it two ways, so the clients that we act for, a large number have made Brexit plans. So they've already incorporated businesses overseas that have enabled them to instantly port their business, whatever happens. So they've done that preparation. And then in terms of the inbound investors, really the flow hasn't slowed. If anything, it's got more advantageous because sterling is so weak against the euro and against the dollar. Buying a property at this stage, assuming that sterling might recover over the future, there's a built-in profit there for them, and they're already, they're wanting to get in now to really capitalise on that. They're the two key trends we've seen.
Okay, good. And you're obviously looking at portfolio across Europe. So how do you see that within that perspective? And is some of the capital saying to you, well, actually, we'll have a pause in London at the moment, we'd rather invest in Berlin, or what's the situation?
Obviously, different investors have different risk appetite. So I would say, if you'll allow me, I would love to comment on your deal because I think it's fantastic that you're coming to London. I think the timing is exceptionally good because from my perspective there's very limited supply coming in over the next 2 to 3 years precisely for the Brexit reason. And I think that if you're providing into the London market something of the kind of quality that I'm sure you'll be building, then there will be an occupier for it. So I think it's too easy to look at London in one holistic way. That's not right. You have to look at markets, and I think so. Well done on your deal.
Oh, no. Still have to build.
That's right. I would say, putting it into context with London versus other European capitals, clearly some investors have decided to pause for breath because of Brexit to see how it plays out. I think there's potentially a wall of capital that is sitting waiting to act, and I think the opportunity will, in my view, be short-lived if there is a resolution to the issue which is seen as acceptable for investors. There will be a very short window where people can step in at the current pricing, is my view. In the broader context, however, many of the other European cities have benefited from that hiatus that's been created in London. And I think so the growth that you've seen in Paris, Amsterdam, Berlin, many of the other major cities, they are benefiting, I think, from that impasse, if you like.
And Will, in terms of the sort of markets when you're looking at secondary office, how's that performing versus, I mean, we've seen prime office performing very well. How is secondary office performing, and are there different areas around Europe or the UK that are interesting to highlight?
Absolutely. I think the the shortage of stock or new development is something which actually we've seen really across Europe, and therefore, whilst many occupiers might be looking for that prime space, actually there isn't necessarily the sort of number of opportunities out there that they need, and therefore that either means that they look to good quality second-hand space, or actually what increasingly we think is going to happen is that it throws up quite a nice opportunity for relatively quick redevelopment of that space to bring back to the market, because at the moment, certainly in the UK, it isn't being delivered at any rapid pace.
And just picking up some of the trends part of it, I mean, Boudewijn, we've been talking a lot and are increasingly talking a lot about things like, for winning cities especially, about wellness, about livability, walkability. The ESG, sustainability side of things, carbon neutral, is coming much, much higher up on the agenda. How important is that as a driver, do you think, both for the investors when they're looking at your sort of developments, but also for the occupiers, the corporate occupiers who will be interested in taking that space?
That's a very interesting one. This morning I was part of a panel with the municipality of Eindhoven, and that's a sort of tech belt in the Netherlands. And that region is very successful. And what we believe that the world will end up with winning cities and with losing regions or losing cities. And that's all driven by the fact that talent is concentrating in a couple of areas in Europe, but also in the US. And where the knowledge is the activity, are the good companies, is profit made, and is, well, demand for good quality buildings, because that's a way in order to attract talent in the buildings. So what we do, we follow these markets. So we have big exposure in Berlin, we have big exposure in Eindhoven, in Amsterdam, we building up exposure in London, because everybody was talking about the banks going down, but the tech is really driving the economy in the London city. And we recently announced 2 investments in Boston. And what you see in America, they have the winning areas on the East Coast is Boston, with all the institutes, with all the universities, and on the West Coast you have, of course, LA and San Francisco area. And yeah, we should also be worried about the losing regions, but I think that's not a topic for today. But yeah, it's clearly where it's going to happen. And I got a lot of feedback from investors. Yeah, if you want to invest in Eindhoven, it's so cyclical. What is
cyclical,
it?
Yeah.
Cyclical. And but I believe that the whole tech world leads to economic growth that is not related to macroeconomic growth, because they can easily produce double-digit numbers. And so there is no real correlation with, let's say, zero economic growth that we have today. So I'm more interested in, let's say, the economic growth of cities and city regions than in the economic growth of the UK, because that doesn't say anything to me.
I agree.
So yeah, I think we see different speeds between areas, cities, and countries, and I'm really excited to see what is going to happen there in the future.
Agree.
And so the planning around where you're going to invest, where you're going to develop, is based around exactly this kind of strategy of where are their tech firms, where are their winning cities.
Yeah, absolutely. It's quite easy, yeah.
Because that's quite like I mean, we had an interesting session on retail earlier this morning, and we're talking there about almost a changing of the guard of the types of retail that people wanted, moving into leisure, moving into F&B, moving into that side. And maybe there's an indication there that some of the big corporate occupiers, whether that's banks or different things, may be changing, and they're more of a focus on the tech side, which would be interesting. John, I suppose, how do you see that as an investor? Are you picking up a lot of those things in terms of wellness, livability? Is that moving up the criteria, and also ESG in terms of carbon neutral and those types of things?
Absolutely. We recently had an internal conference to discuss our own investment strategies, and for me the 3 major things that came out from the office perspective was the continuing urban intensification of the winning cities, was technology and ESG. And those are the 3 very long-term trends which I think you need to be aware of, particularly from our perspective, where we typically invest for long-term core holders. Because I agree there are some short-term opportunities potentially where there's a supply-demand imbalance, and that there's opportunities to get access to stock and to turn it around quickly in some of those other locations. But for a very long-term investor with a 10-year plus horizon, my view would be, as just been described, is to stick with the winning cities, because that's where everybody's focusing.
And Andrew, from your point of view, are you beginning to see, therefore, more of that sort of longer term money beginning to look more closely at the UK market? And is that just London, or is that also going out to Glasgow, Edinburgh, Birmingham, and the larger regional cities?
Yeah, I think William put it very well earlier on when he was talking about investment and there being a lot of excess capacity. I think in the UK, London is still the place people want to go because it's seen very much as a safe bet. I think when you drift outside of London, it's a bit more of a roll of the dice. Just jumping onto the themes point, which I thought was quite interesting, there's a big occupier theme. If you look at the major tenants now, those businesses didn't exist 10, 15 years ago. The Amazons of the world, the Microsofts coming into the UK and taking out tens of hundreds of thousands of square foot, a large number of those businesses didn't exist, and their workforce is all sub 40, sub 35 years old. The expectations on what a building is going to do going forward does not resemble the expectations of a building when I kicked off work. So I think that's probably the biggest theme, is how are investors going to identify and develop properties which are then going to meet the needs of the businesses that will exist in 10 years' time, as opposed to looking at what we've got right now.
And does that mean, John, that you're having to rethink some strategies around lease length, those kinds of things, think that some of that will need to be more flexible in terms of the needs of occupiers going forward?
Again, it really depends on the asset, but typically we are looking to introduce, certainly in the larger buildings, more flexible leases in certain parts of the building, and so trying to, as I said earlier, ensure that an occupier remains in the building not because you've tied them to a long-term lease, but because you are offering them the amenity, all the services that they want, and that flexibility, and they will pay for that. So there is some value left on the table in my mind if you don't offer that flexibility and operate the building well enough to still maintain your sustainable income.
And so the same with many aspects, that actually that asset management, making sure that you're following what the occupiers are looking for and making that as best possible, is really a key driver at the moment.
Yeah.
Will, just coming to you in terms of what you're seeing from, I suppose, the value side of it, yields, rents. What's your sense of that across Europe? Are there particular hotspots?
Well, I think what we're seeing overall is that yield compression has sort of effectively come to an end. But every time we do our quarterly research and we update it, it seems to have crept down another couple of basis points just about everywhere. So we can keep saying that, and actually it's going to keep coming down. And we sort of touched on some of the reasons earlier on. If you go back to this time 10 years ago, across many parts of Europe, office yields were actually below bond yields, which just sort of seems incredible now. Today we've got a sort of anything from 300 to 500 basis point clear margin between an office yield and a bond yield. So I think in some ways there's still a bit of room there for compression, but in reality where we see most of the return coming from now is really sort of rental growth for some of the reasons we've just discussed.
Okay, good. I wanted to pick up a little bit on Berlin, both as a...
May I comment on this? Because I'm also a little bit of a financial guy. What I really... what is really interesting is about the negative interest rates and the impact on real estate for the future. I was in a group with bankers a couple of weeks ago, and I told them, can you imagine an investor entering into a lease and that the investor starts paying the rent to the tenant?
Yeah.
That's actually what it is. And so the yield compression, I think, is not to an end, because we are late in the cycle and interest rates go down. So I am really curious what is going to happen with all the values, because the sensitivity of a yield compression at these low interest rates is huge. The leverage is extreme, and I wonder where we will land. But maybe it's a question to you.
Well, as you know, you can fix. Thank you for that. You can you can fix very low levels of interest for very long periods of time now. So we are looking for some of our investors to fix. Looking at 10-year horizons. So it still makes perfectly good sense, particularly if we go back to what we were saying earlier, if you're buying assets which you believe in the long-term future, and they're in these winning cities. We're already at a point where rents are at their highest level and yields are at their lowest level in most markets across Europe. We're already there. So your point is very valid, but I do think that for our investors, a geared return can still...
You're not going to pay the rent?
No, we're not going to pay the rent. No, no, you're right. No.
But it's interesting how the perception has changed over what is a relatively short period of time where US rates were starting to go up. Everybody was assuming this was typical end of cycle, that they would continue going up, that would be followed here, and the complete change.
But what happened a couple of weeks ago, there was a sort of reset in the allocation of money. They allocate money to bonds, to shares and to real estate. And what you've seen in America is that due to these bad returns, 10% more is allocated to real estate.
Yeah.
And what immediately happened then is a lot of money flew to the New York real estate market, because 1% out of the 100 and 10% more in real estate has an enormous effect. It immediately led to a couple of big transactions.
Yep.
And from an occupier perspective, we're already late in the cycle, because vacancy is growing in New York City. So you see different cycles happening at the same time, but they don't have any relation with each other.
Yeah, and that's the States. And if you then overlay Asia, where yields have been very low for a very long time already, they come to Europe and they see very good returns, particularly on a geared basis. So, and they're also often getting a currency benefit from hedging. So there are very good reasons why investors are not scared by current pricing.
When we're looking at Germany, because we're in Germany, Berlin seems to me, anyway, to be taking off and becoming a life of its own, and will end up, in my view, back to being a very, very substantial capital city. Versus the other cities, you will still have that fundamental, different centres, but I think Berlin is going to get much bigger. Do you share that view? Does anybody want to say Berlin's great and Munich's not, or
not
anybody going to be that daring? How do you see the German cities?
I'll start if you like. When I look at Germany in the context of Europe overall, and when you compare Germany to France and the UK, for instance, the rents are half on a per square metre basis. So to me, it still looks like it has some way to go. So if you're a tech company that wants to, recruit the best people, Berlin is a fantastic city, and it offers a relatively low rental base. So why not?
Will?
Well, I'd second all that. And what I'd also say is I think what we've seen now, and I think it's sustained, is that actually you do have the liquidity in these markets to make them competitors to some of the other large sort of European capitals, whereas maybe sort of 5 or 10 years ago it wasn't quite in the same league.
Okay, good. I want to finish off just with a quick view from everybody in terms of where they're seeing the current opportunities in Europe, so you can choose whether or not that's a destination, whether it's a sector in terms of the types of office. That's up to you. But where do you think the most attractive opportunities are at the moment? Let's start with you, Andrew, just in terms of, I suppose you can reply from that in terms of what you're seeing from your occupiers that you're representing, but where do you see the most attractive options at the moment?
I think a little earlier we talked about where's the workforce of tomorrow going to come from, and therefore where would you build a building, and that would be my mindset. So actually picking Berlin, Munich, places with great universities where actually there's a population, I think is absolutely the way forward. And I think you'll see that in countries like France with Paris as well, where actually if you have a large population aged between 20 to 40 living in the city centre, there'll be buildings to fill and occupy, and I think that's where the value is. So I think you'll see London still continue to do well, but I think certainly Berlin and Paris will go from strength to strength, would be my prediction.
Okay, good. And Paris obviously got the Olympics coming up and Grand Paris. What's your view?
The broader answer to that would be large, multi-let, tech-enabled, sustainable buildings in winning cities. That would be the key focus. If you wanted to try to narrow it down to something else, I mean, there are some great opportunities through transport-led regeneration. So again, where transport is the significant infrastructure being spent, another great place to kind of tweak that model. But that would be the wider answer.
Okay, good. And Boudewijn, you'll be able to tell us by where you're planning to invest next, I suspect. Where are your developments next? Or however you want to answer it, do.
To be honest, I think the countries that we're in, I think they are deep enough to find more opportunities. Because if you move to another country, you have to get familiar with the tax, with the law, with everything, all these institutions. So that is a big investment in itself. So we see enough opportunities in the US, in the UK, and Netherlands and Germany right now.
Okay, great. Well,
I think everybody's already said it very well, but it's sort of education, innovation, and technology. I think the thing I would add to that is that, yes, that's clearly Berlin and places like that, but actually it could be increasingly further afield into sort of Central and Eastern Europe as well. And it's just about picking a specialism that we think is going to then fly over the next few years.